Welcome to The Explainer. Today, we're going to crack the code on what really makes a company successful. You know, it's not always about those big, flashy numbers you see in the headlines. We're going to dig a lot deeper to find out what's actually going on.
All right, so to kick things off, let's start with a little puzzle. This is a perfect way to see just how easily we can get fooled by the standard metrics everyone uses.
So have a look at these two companies, In-House Co. and Contract Co. We're looking at a key metric here, return on invested capital, or ROIC. And wow, notice that huge difference? Contract Co. has this massive 71.2% ROIC, while In-House Co., well, it's sitting way down at 13.3%.
Okay, so just based on that one number, which company are you putting your money on? I mean, it seems like a no-brainer, right? But hold that thought. We're going to circle back to this. But first, let's unpack why this question is way, way trickier than it looks.
Now, ROIC is kind of the go-to metric for a lot of analysts, super common. All it's really telling you is how much profit a company squeezes out for every single dollar it invests in its operations. But as we're about to see with this puzzle, it just doesn't always tell the whole story.
And one of the biggest reasons why is how standard accounting deals with things that are supposed to build value for the future. The classic example here, research and development, or R&D.
So check this out. The way the rules are written today, R&D gets treated like an immediate expense. It's subtracted from your revenue right away, in the same year you spend it, just like you'd subtract your electricity bill. But you can probably see how that might seriously mess with our view of a company's real long-term health.
I mean, that just doesn't feel right, does it? R&D isn't like paying the rent. It's an investment in the company's future. So what if we started treating it that way? What if we capitalize it? Basically treat it like an asset, like a factory or a machine that just loses a bit of value over time. Just making that one little change, it completely flips the financial picture on its head. Okay, so here's how we actually fix the numbers to get a clearer picture. We take the profit they reported, we add back all the R&D they spent this year, and then we subtract a little bit for the R&D investments from past years. That little subtraction is called amortization. It's just a fancy way of saying we're spreading the cost out. And as you can see, making this adjustment totally changes what the company's profit looks like.
In this graph, this shows the long-term impact perfectly. That dark blue line, that's the ROIC they reported. Looks pretty good, right? It's climbing, it's leveling off, but look at the light blue line. That's the more accurate version. And it tells a completely different story, that the company's real returns have actually been going down for years. We're getting two totally opposite narratives from the very same company.
You know, the problems with ROIC don't even stop there. In some situations, this metric isn't just misleading, it completely breaks down. It becomes useless. Let me show you what I mean.
All right, now this is where things get really interesting. Take a look at the number on the screen. Negative $1.5 million. That was the invested capital for a sample company back in 2017.
So, how is negative invested capital even a thing? It sounds impossible, right? But it actually happens when a company can get its customers to pay way up front, and at the same time, it pays its own suppliers really slowly. Essentially, other people are funding the business for free.
And here's why that's a huge problem for our metric. When that invested capital number gets close to zero or even goes negative, the whole ROIC calculation it goes haywire. You're basically trying to divide by zero or a negative number, and the result, as you can see right here, is not meaningful. The metric just flat out breaks.
So, if ROIC can be misleading, or in some cases just completely broken, what are we supposed to use? We need a better yardstick, a more robust one, and that yardstick is called economic profit.
Economic profit is just such a powerful concept for getting at the true value a company creates. Think of it this way. It's the profit that's left over after you've paid for absolutely everything. And that includes paying a kind of rental fee for all the capital, all the money from investors and lenders that's tied up in the business.
In the formula, it's actually beautifully simple. It's just your net operating profit after taxes, your NOPAT, minus something called a capital charge. And that charge is just that rental fee we talked about. It's the return investors expect for taking a risk on the business. If the final number is positive, hey, the company created value. If it's negative, it actually destroyed it. Simple as that.
Okay, so now let's take this powerful new idea and put it to the test. We're going to use economic profit to finally solve that puzzle from the beginning and see who the real performers are in a couple of these tricky cases.
Remember our big mystery? In-House Co. versus Contract Co.? Well, here's the big reveal. Yeah, Contract Co's ROIC was through the roof, but look at the bottom line, their economic profit. It's $3.2 million, which is exactly the same as In-House Co. They created the exact same amount of economic value. They were equally successful. They just used totally different business models to get there.
All right, here's another classic head fake for you. On this chart, we've got a company called Return Co. Its ROIC is a staggering 105%. I mean, it's just absolutely dwarfing its competition. Looking at this, you'd think they're in a league of their own, right? The undisputed champ.
But what happens when we switch our view to economic profit as a percentage of revenue? Now the real story comes out. Look, Return Co. is still a great performer. There's no doubt about it. But check out Peer 10. That company is actually creating the most value relative to its size. See, economic profit gives us that crucial nuance that ROIC completely missed.
And this idea holds true even when you're looking at different parts of the same company. For this business, their software division has one of those not meaningful ROICs, but it's still generating a ton of economic profit. Meanwhile, the hardware division has a pretty low ROIC, but it creates the most economic value in pure dollar terms. Economic profit lets you actually compare apples and oranges on the same scale.
So what's the big takeaway here? It's that to really, truly understand a business, you've got to look past the headline numbers. We've seen that how you account for big investments like R&D is absolutely critical, and that a popular metric like ROIC can be seriously flawed or even useless. Economic profit? That's the metric that cuts through all the noise and tells you, in cold hard dollars, which companies are genuinely creating wealth.
And that's why all of this really matters. It gives you a much more powerful question to ask. It takes you from just being a casual observer to a really sharp analyst. So the next time you see a company getting praised for its super high, flashy returns, you'll know to stop and ask the real question. Yeah, but what is its economic profit? Thanks for joining me for this explainer.